Welcome everyone to our webinar. We're so excited to see you. We see familiar names and we see a few new names. And we are just so excited about the content that we're going to present today. And the intent of our webinar is to be interactive. So you'll be able to ask questions throughout the webinar. And if you have a question, please just put it into the Q&A. And then also feel free to hit that reactions button if you like to maybe liven things up a bit if you hear something that's funny or give it a thumbs up. We do appreciate the feedback. And and then also, if there's some topics that you would like for us to cover in the future, please just put it in the chat. This is our second webinar, and many of you attended our first one, and we got some really good feedback. And so there's just so many topics that we could cover, but we want to make sure that it's meaningful to you. So if you have a really interesting topic that you would like for us to cover, please just put it into the chat. And yes, this webinar will be recorded, and you will receive a replay. And then one last thing, because of compliance, we're not able to give investment recommendations. So before implementing anything that you hear today, be sure that it's appropriate for your financial situation and consult with a financial professional. So let's dive in. So most of you know me. I see a lot of familiar faces. I'm Angela Dorsey. I'm the founder and financial advisor here at Dorsey Wealth Management. My firm is about 13 years old, and it's really amazing how time flies. And I majored in computer science and then got my MBA from UCLA. And I spent about 25 years as a compensation specialist, and I enjoyed what I was doing. However, I felt like there was something else that I was meant to do, and I always had an interest in financial planning. And even as a little girl, I would read Money Magazine and things like that, really weird. But while in corporate, I found myself helping, my colleagues, especially women, understand their 401(k) and their finances. And I just really enjoyed it. And I thought, wow, wouldn't it be great if I could do this for a living? And so I gradually transitioned from corporate to my own firm. And every day I'm just so happy to be able to do what I want to do, to be able to have such joy and have a rewarding career. So with that, I'd like to introduce our Associate Financial Advisor, Amy.
Thank you, Angela. Well, my name's Amy Marietta, and I have a bit of an unusual background. I have a 20-year career in flute performance behind me at this point. I still do a little bit of teaching on the side, but I had an arm injury, and I was trying to figure out what direction I wanted to go next. And I realized that the only other thing that I was as passionate and nerdy about as music was money. So I decided to go back to school, and I really wanted to focus on empowering women in that process. I was raised by a single mother, and I really did see all the challenges she faced as she was trying to figure out how to navigate wise financial decisions while also kind of navigating all of the issues that go along with being a single parent and a woman on her own. So I really wanted to make sure that I was working with women. So it just felt like absolute kismet when I met Angela through the Financial Planners Association. And I was so excited to hear how many similarities we had, and our goals are so similar and aligned. So I was really, really excited to join the Dorsey team. And I really hope that in doing these webinars and in all of our client meetings that we just get rid of some of the mystery and the shroud of financial planning, and that it becomes kind of an everyday feeling and conversation that's just a part of life, and it doesn't feel like it's this confusing, befuddled maze that we're trying to navigate. So that's my goal as I entered this field, and I'm so excited to be a part of this.
Well, that's a great goal. And yeah,
One day at a time.
one day at a time, one person at a time. Yeah,
Exactly.
and also, Amy, it's just been really great having you as part of the Dorsey Wealth Management team. And I have a fantastic team. And I also have Michelle Arns as our client service manager. So I'm very fortunate to have such a great team. Alrighty, so today we are going to cover commonly asked questions that we get from our clients regarding investments. And feel free to put your questions in the Q&A if we don't address the ones that are on your mind. And a disclosure, this webinar is for educational purposes only and does not constitute investment advice.
So today we're going to be focusing on investment planning. As you can see from this chart, there are many different segments that make up a complete financial plan. And through these webinars, we're hoping to address each one and possibly more than once. But today we are going to focus on the investment side. And a lot of people really think that investment management is kind of the core of financial planning. It is an important part of it, but it is simply a part. There are many other areas that we have to factor in when we're working with a client, and we want to make sure that we address all of them. So we really say that financial planning is anything in your life where money is affected. So it's all of these different areas. So again, if you have any suggestions along the way, we would love to hear your thoughts on other topics that we should cover in these webinars.
Yes, absolutely. Thanks, Amy. And one of the suggestions that we got from many of our clients was that this chart here that you're seeing could actually be a model
Mhm.
for future webinars. We thought
Mhm.
that is brilliant.
Yes.
And so last time we focused on retirement planning. Now we're focusing on investment planning. So as you can see, there's a lot of different parts of financial planning that we can cover. And then within each part, there's subsets of that. So we could have webinars forever and not
Mhm.
run out of things to talk about. But
Absolutely.
anyway, thanks, Amy. Thanks for covering that. And so before we dive in, the clients that we have now, this will sound very familiar. But let's review what our investment philosophy is, what Dorsey Wealth Management's philosophy is. And we believe in having a well-diversified portfolio of low-cost mutual funds and ETFs that are properly allocated to support your risk tolerance and goals. Now, that I said a lot there, and we're going to cover a lot of what that means in future um, slides here. But we'll explain, well, what does that mean? That sounds good, but what does that mean? And so we will cover that. But what we'd like for you to really take away from this one slide is that we do not believe in trying to time the market. And we have a slide for that in terms of what can happen if you try to time the market. And we believe in creating a long-term investment strategy and really sticking with that strategy to get you through the market's ups and downs. And as you can see, we kind of have three pillars here. And we really do stick with that. And it's difficult to stick with it when times are tough. I think when times are good, everything's great, the market keeps going up and up and up. That's easy. That's the easy part. But the challenge is when it's volatile, which we've experienced a lot of that since January. And so, with this philosophy, holding fast to it has really seen our clients through the bad times. All righty. And so on volatility, uh, one question that we have been getting almost in every meeting, right, Amy?
I almost every single meeting. Yes.
Yes, it got to a point where we said, you know what, let's just talk about volatility right now.
That was how we started each one
Yeah,
after a
'cause
period.
we know it's on your mind, and let's just beat you to it. Let's just talk about it now. And so the question, should I worry about stock market volatility? And I tell you, this is one of the most common questions that we have been getting since January. And especially, when the headlines are so dramatic and scary, and the markets drop a few hundred points in one day, we're just not used to that type of volatility. What's going on? So the short answer is it's really normal to feel nervous. But no, you do not need to worry if you have a plan and stick to the plan. And market ups and downs really are the price we pay for long-term growth. And without risk, there's no reward. And we have a really great slide about that coming up. And so even retirees, many times our retirees say, but I don't have 10 years, I don't have 20 years. But even retirees need some growth in their portfolios to stay ahead of inflation and to preserve purchasing power. If all of your money's in cash, you are still losing money because of inflation. And so, looking at this chart, so if we zoom out, looking at this chart, the market has always recovered from recessions, wars, and even political turmoil. And we don't build your retirement plan assuming everything will be smooth sailing, because that's just not the reality. We wish it were, but it's just not the reality. And so we expect rough times, and we plan accordingly. So that's why in your portfolio, we include equities, we include fixed incomes, your investments are diversified, and we'll talk about what diversification really means. And we also rebalance, and we'll talk about what rebalancing means. And so trying to time the market, meaning getting out during downturns and then getting back in when the market recovers, almost always leads to worse results. So you don't want to be out of the market during the best days, which oftentimes comes right after the worst days, if you've noticed. Um, and you can't control the market, but you can control your spending, your asset allocation, and most importantly, your emotions, your reactions. You really want to make sure you don't have an emotional response to what is going on in the market. You want to stick with the plan. And so, so with that, you really, really just have to stick with the plan.
I
Um,
think one thing that's really interesting is you never really see a headline of market went up 500 points, but you do see the market went down 500 points. So it really is something where if we're going to pay attention, you want to pay attention both directions. And the reality is that that amount that it's shifting isn't enough to blow up your timeline. It isn't enough to blow things up in general for you. So you want to make sure that you're responding logically as opposed to fear-based. And I think that's the hardest part of all of this is we all do have reactions when we're reading these headlines, but that doesn't necessarily mean that they're feelings that we should have action on. We want to make sure it's thoughtful and intentional.
exactly, exactly. And we do have a question. It's a really good question. How do investments like gold tie into the volatile picture? That's a really good question.
Mhm.
And we know that gold has also received a lot of attention in the headlines as this is a safe haven. And as a result, you see how well it's been doing. And gold can have a role in your portfolio. It's one of those things where if you have like a diversified portfolio, then you may not need gold. And so I think it really depends on your situation. To be heavily invested in gold, we don't advise that. And it's very volatile and it's not very liquid. You can't easily transfer that and purchase, what you need to buy that you may want to use the gold for. So we don't advocate or plan on gold in our clients' portfolio. If that's something that you want to have, like for like your fund money, or just like with an individual stock, if you have an individual stock that you really want to purchase, then we'll um, we won't discourage you, but it won't be part of your overall financial plan. So I hope that answers your question. Let's see here.
Another question is, should gold be less than
Ah.
5% of your portfolio value?
I would say so. Yeah. Yes, I would say so. In general, when you think about alternative investments, when you think about investments that aren't really part of your official portfolio, we do try and limit that to 5%. Now, of course, that's a rule of thumb, but I think 5% is a good number to aim for.
Mhm.
Let's see. Okay. All righty. Let's move on. Let's see. Okay. So to transition to the missing the market's best days, Amy, why don't you take this one?
Sure. Well, here's a chart that kind of shows how trying to time the market and then missing the market's best days can really hugely cost you. So if you look at the growth of $10,000 in the S&P 500 over the last 29 years, if you had stayed invested all days, fully invested all of the days, you would have $224,278. If you missed the best 10 days, you're down to $102,750. If you miss the best 20 days, you're down 73% to $60,306. And if you miss the best 30 days, you're down 83% down to 80, or excuse me, $38,114. So, I mean, that is a dramatic and huge difference. And again, as Angela said before, often these best days come after dips. So if you have reacted in fear and withdrawn money, you're very, very likely going to miss these best days. In addition to withdrawing your money when it's at a low, so you're selling low, you're going to be re-entering trying to buy high, which is definitely the opposite of what we're all aiming for as we're investing.
All righty.
So with that in mind, rebalancing can also help you keep on track. So over time, some of your portfolio, you might see it grow faster than others. And rebalancing can help us keep your allocation, which basically just means the areas where you keep your money, aligned with your plan. So rebalancing is the process of adjusting your portfolio's asset allocation to match your investment strategy. And that's something that we discuss in client meetings. We want to make sure that we're really adhering to the plan. And this is often done by buying or selling assets that have moved significantly from their target percentages. So as we just discussed, we are aiming to buy low and sell high. And rebalancing inherently helps you do that in a very disciplined way. It's really important to really personalize the process of asset allocation and making sure that you're taking into consideration all the different variables within a person's life and not just kind of go with the media's, okay, you've retired, you're in a 60/40 portfolio, boom, you're done. You don't ever have to think or reassess that ever again because that's not appropriate for everyone. We want to make sure that we're looking at the size of your assets, we're looking at your values, your goals. Your risk tolerance is hugely important. Everyone responds very differently to the volatility of the market, and we want to make sure that we're preparing your portfolio for that. If you are very, very risk averse, then more likely you're going to want a higher allocation of bonds. It's a more stable area to stay, and you'll want less stocks and have less volatility because of that. But some people, even into retirement, are like, give me all the risk. I'm totally fine with it. And those
Right.
people might be more like a 70/30 portfolio or even higher, depending on really the size of their portfolio and how they feel about it. So
Exactly. Exactly. Okay, great. Well, thank you for that. And let's get to our next question. What happens to my investments in a recession? We've been hearing that word recession a lot. And when we hear the word recession, it's easy to picture financial doom, but let's separate fear from the facts. And yes, recessions are very uncomfortable, but they really are a normal part of the economic cycle, and they don't last forever. During recessions, stock prices fall, and sometimes significantly. It can be scary. And that's because investors anticipate slower economic growth. But history shows that these declines are usually temporary, and markets tend to recover well before the economy officially does. So your portfolio with us, it's not all stocks. You do have bonds, fixed income, especially high quality ones, and they often hold their value or even increase during recessions, and that helps to cushion the impact. And we use market downturns as an opportunity to buy more shares at lower prices. As Amy was talking about rebalancing, we do that, and that's a way to buy stocks on sale. And so, this is really a disciplined process. It's not emotional guesswork. We design your portfolio knowing that recessions will happen. It's inevitable. It will happen. And so it's not a surprise, and it's part of the strategy for your portfolio. And, we make sure that you have a cash reserve for near-term needs, and the rest is invested for long-term growth. A recession may feel like a setback, but for a long-term investor with a thoughtful plan, it's really to set you up for future gains. And the key is to stay invested, be diversified, and also stay calm. And then what we're seeing here, this is a chart that shows the performance of the S&P 500 over a 1, 3, and 5 years after a downturn. So 1, 3, and 5 years after a major downturn in 2001, 2008, and 2020. And as you can see, with each example, except for 2001, the market still did go down, but then it went up, then up again. And as you can see in 2008, immediately after that, in the 1 year, 3 year, 5 year, it did go up. And then in 2020, it went up by a lot, huge increase. And so, just like we mentioned before, that oftentimes after a huge decline, the very next day or the very next week, the market does recover. And you don't want to miss that. And so that is, I thought that's a nice visual there. And let's see here. Uh, okay. All righty. Moving forward. That's good. Moving ahead. All righty. Now, politics. Politics in the stock market. They're often entangled in the news cycle endlessly, but they're not as tightly linked as people think when it comes to your long-term investments. And yes, elections and policy changes can create uncertainty, but uncertainty doesn't equal catastrophe. And especially when we stay focused on what we can control. The stock market cares about many things like corporate earnings, interest rates, inflation, global events, not just who's in the office. So as you can see with this slide, historically, markets have risen under both Democratic and Republican presidents. Markets dislike uncertainty, so it's common to see short-term volatility during election years. But after the dust settles, markets usually refocus on the fundamentals and not the political headlines. And certain policies can help or hurt certain industries like energy, healthcare, or tech, but a well-diversified portfolio helps to smooth that out. And we don't design your retirement plan based on who's in the White House next year. We create it to last the long term through decades. And so that's where financial planning is really powerful. It gives you the confidence no matter what's happening in Washington. And some of the worst investment decisions come from mixing politics with your portfolio, like moving to cash because of a certain election outcome. That almost always backfires on you. So instead of asking, who's in charge of the country, it's best to focus on who's in charge of my financial future, and the answer should be you, and make sure that you have a plan that works in any environment. It can be hard to focus on that, but that is sticking with the plan, sticking with the fundamentals. Okay, let me just take a little look here and see. Um, okay. See if we have any questions. All righty. Okay, none at this time. All righty. Okay, so let's move on here. We talked about asset allocation, so Amy will talk more about, well, what does that mean?
Yes, that is definitely a question we hear quite a bit. Asset allocation is a very fancy way of saying something very simple and very practical, and that is how we divide your money in different types of investments, such as stocks, bonds, and cash. There are other forms as well, but we won't get into every single one of them. It is one of the most important decisions that we make together when we're in meetings with clients because it has a huge impact on your long-term success and goals. And each of these assets has a necessary function. So stocks can provide growth alongside their volatility, and bonds are the stability, and cash is your emergency reserve. So how much of you hold of each of those will depend on your goals, your risk tolerance, and your time horizon. Studies have shown that over 90% of a portfolio's long-term performance comes from asset allocation, not market timing or picking the latest great hot stock. It's about strategy. So we don't want to speculate on all of these decisions. We're trying to actually create a historically proven strategy here. A person nearing retirement will really likely have a different allocation than someone who's in their 30s, let's say. And as your life changes, which please let us know when things like that happen. We like to be a part of all of that. But as your life changes, we want to adjust your allocation appropriately as well. So the right allocation is what helps us sleep at night and stay invested when things are tumultuous. And it gives us confidence because the money is working with a plan. We can see historically what's going to happen. We have an idea of the trajectory. And again, we're taking into consideration your risk tolerance as well. So this chart shows the different risk reward trade-offs that come from different asset allocations and the average return over a 24-year period. So as we can see on the far left, we're 100% stocks, far right, we're 100% bonds, and most of our clients land somewhere in the middle of those. And you can see that as you have more stocks, there's more volatility. You might have a great return of 36%, but you also might have it drop 39%. So there you have to be willing to ride out the waves of both of those if you're really highly invested into stocks. But as Angela touched on with inflation, we have to be really careful to not be 100% in bonds, because if you have a 3% growth, that will not cover inflation all year. So we want to make sure that we're kind of straddling the line between those two things while taking into consideration everything else that we've discussed in terms of personalizing it to a client's needs. So it's really important to determine where you lie in what you are comfortable with, since this really is about your money. We are here to support you and your goals. So
Thanks, Amy. I really like this slide because it's a nice depiction of the risk and return trade-off.
mhm.
And I also like how it also puts there the average return. Now, of course, this isn't predicting what will happen in the future, but it shows over the past 24 years, what the average return is. And so, for example, if you have a 60% stock, 40% bond portfolio, the average return, like if you were to look over that period, the average annualized return is 7.23. And that's a very healthy return. And in our retirement projections, we like to put in a very conservative 5% just to be very conservative in how long your portfolio will last, knowing that odds are it will actually beat the 5%. And so, I just like how this depicts, there's a lot going on this slide. So,
Yes.
yeah, thank you. Thank you. All righty. So, what is a diversified portfolio? And do I have one? If you're a client of us, yes, you do have a diversified portfolio. And a diversified portfolio is an investment strategy that spreads your investments across various asset classes, industries, and geographies to really reduce risk. It's like not putting all of your eggs in one basket. And instead of putting all of your money into one type of investment, a diversified portfolio aims to balance potential gains with potential losses. And so for most of you, when you look at your portfolio, your portfolio is very well diversified. You have United States companies, you have large US companies, medium-sized US companies, and then also small companies. You have real estate companies, you have international, emerging markets, you have short duration fixed income. That's at a very high level, short-term bonds, say from 1 to 5 years. And then you also have intermediate fixed income, which typically are bonds with a duration of, say, 7 years on average. But the point is that a diversified portfolio really has different pieces in industries, classes, and geographies to reduce risk. And what you see here on the slide, this is not a portfolio recommendation, but it's really an illustration of how you can have different types of investments within a portfolio. All
I
right.
think one of the most common questions we got this last cycle was also, do I have international? Because I think that was kind of the buzz at the time, just like gold is at the moment. So it's
Yes.
really interesting to see all the questions that come up during client meetings based on news headlines. So And very good questions, by the way. It's important to know that. So by no means, like we want to hear all of the questions, and I know that it's really overwhelming sometimes by what we're being inundated with in the news. So yes, please bring all the questions to the meetings. We love them.
All righty. Now, another question we get, which is more on the techie side, but we'll cover it. What is the difference between a mutual fund and an ETF? And at a very high level, both of them pool investments. So both of them are very diversified in terms of what's inside of it. But they start to differ when you look at trading. And so ETFs, they trade like stocks on the stock exchange with continuous pricing throughout the day. And so when I purchase or sell an ETF, I get the price immediately. So it's like a stock. Now, with a mutual fund, what's different is that when I purchase or sell a mutual fund, I get the price at the end of the day. And so it's not like a continuous up and down. It's whatever the price was at the end of the day, that's what you get. So trading is very different in terms of how mutual funds and ETFs are handled. And then also costs. In general, ETFs have lower expense ratios than mutual funds. And then I think more importantly, the tax efficiency. The ETFs in general are more tax efficient than mutual funds because they can avoid some of the capital gain treatment that a mutual fund would be subject to. And so ETFs can be more attractive in taxable accounts, like a trust account, um, because you don't get as many of the capital gains and the tax hit that, say, a mutual fund may give you. And I keep using the word may because it really depends on what the investment is. It depends on your tax bracket. But in general, ETFs are more attractive in taxable accounts and for clients in higher tax brackets. Yeah. Do we have any questions on that one?
I
Ah,
see some questions that are a little more personalized, and
I
we're happy to answer some of those by email if you want to pop an email to us. We're staying a little more broad right now on
Yeah, I
this.
see a question here. Do you invest in alternatives? In general, no. I have found that for most people to achieve their financial goals, again, going back to our investment strategy, having a well-diversified portfolio of low-cost mutual funds and ETFs really helps to deliver the results that they need in their retirement plan. And it also delivers an experience that isn't so volatile, or it's a smoother experience that gives them a better investment uh, experience to make sure that they stay invested and enjoy the journey. So in general, no, we don't recommend alternatives. But thanks for the question. Okay, great questions. Thanks, everyone. All righty. Okay.
All right, so the next is what countries are in an international fund versus an emerging markets fund? That is a very good question. It is a little bit weird to hear two forms of international funds described differently. So typical countries that you'll find in an international fund are Japan, United Kingdom, Canada, Switzerland, Germany. And the typical countries you find in an emerging markets fund are China, India, Taiwan, Korea, sometimes Brazil's thrown in there as well. So those are typically the distinctions. They're just different countries in each of the funds. So you'll see that there's a split based on country that they're investing in.
Yeah. Yeah, so we get that a lot. And so yeah, it's just interesting to know. And the countries, it really depends on the investment too. Like,
Mhm.
one international fund may contain a different basket, but just in general, these are some of the countries you would see in an international fund and then emerging markets.
And those are the largest concentrations. There are
Yeah,
tons of smaller countries that are included in both of these funds. So,
yeah, that's a good point. There's a ton of countries, but these are the ones with the largest allocation within that fund.
Another question we get a lot is what investments are in a real estate fund? And am I invested in real estate? That's the other one. So the answer is if you're a client of ours, yes. Uh, a real estate fund is often called a REIT or a real estate investment trust. So the REITs will typically include residential, retail, healthcare facilities, office spaces, mortgages, and in a fun way, so cell tower leases. That was always a fun one for me. REITs are companies that own, operate, and finance income generating real estate, often commercial. They're structured like mutual funds, and they allow individual investors to invest in large scale properties without direct ownership or management. And REITs can invest in various property types, as we've just discussed. So, like office buildings, shopping malls, apartments, industrial facilities. And their primary goal is long-term operation of real estate as a part of an investment portfolio rather than reselling developed properties. So that was all a mouthful. And it basically just means that an individual investor can invest into commercial properties without actually buying them. So it's a way to have a more liquid form of real estate investments.
Yeah, thank you. Yeah, I really like REITs because they're a great diversifier. They often move in different ways than the general stock market and the bond market. So adding real estate really helps to create more of a diversified portfolio. And it's fun to own real estate without being a landlord.
Yes. And there are different types of REITs as well. Some of them are international. So it is possible to own international REITs as well as US.
Hmm. Absolutely.
The next slide is my favorite.
Yes. What are investment fees and how can I look that up? And this is a really great slide here because it shows what an investment can cost. And in this example here, we pulled this up. This example actually has a load, a 5.75 load, and a load is like a sales charge. And then it also has an expense ratio of 0.77. And to put this in terms of, well, what does that mean? If you invested $100,000 into this fund, immediately 5,750 would be just taken out of your account and as a sales charge. And the industry is really moving away from load funds. I think you would see less and less of loads. We have never recommended a fund that has a front load. It's you really shouldn't have to pay someone that amount just to invest for you. And so and then the expense ratio, that's ongoing. So every year, this particular fund charges 0.77 on the account balance. And it's not like you see that in the um, statement that you get. It's really taken out of the returns. So they have the returns and then they take out their expenses, and then the net return is net of expenses. And to put this in perspective, for example, we really like dimensional funds, DFA. They have very low fees. And one fund that we like, the Dimensional U.S. Core Equity Mutual Fund, it has a expense ratio of 0.150. So if you compare 0.15 to 0.77, you can really see that's a big difference. And so again, going back to our investment philosophy is to invest in low-cost mutual funds and ETFs, and then also an ETF that we use, the Dimensional U.S. Core Equity, that has an expense ratio of 0.17. And so again, very, very different. And those fees add up because it's every single year that you have that.
So to bring it back, the example on the screen would be the $770 per year versus this ETF that the dimensional ETF that Angela just mentioned would have $170 per year fee. So that's significant over a course of a lifetime if you're staying invested within the same fund. That's a huge amount of money that you're saving long term. And a lot of people do not look at the expense ratios on the funds they invest in when they're doing it individually. So it's amazing how all of a sudden you'll kind of look at something and you're going, I'm paying how much in fees? That's blowing my mind.
Yeah, and you don't even know. So
Mm.
again, this is using Morningstar and it's free to anyone. just, Google morningstar.com and then input the name of the fund, or if you know the ticker symbol is usually, just like this one, the ticker symbol is CWGIX. Input the ticker symbol, and that will let you know how much you are paying um, to have this particular asset. And and again, it's each year. Each year you're paying that. And so, yeah, morningstar.com. And yeah, I think, that would let you know. And the industry as a whole is really trying to lower fees. I know Vanguard is doing an excellent job. They've always been really great in doing that. And the other mutual fund companies are following suit. You have any questions on that? Okay, so I already answered that question. All righty. Okay, so key takeaways. Your plan is built for uncertainty. And sometimes it's really hard, depending on what's going on, depending on the news, depending on the stock market. It's very easy to feel uncomfortable with what's going on. But again, we planned for this, and your plan is built for uncertainty. And ups and downs is a normal part of the stock market. So it's not something that is a surprise. We do plan for it. And we also try and take advantage of it through rebalancing. Timing the market doesn't work. I really like that slide that shows how much money you would lose if you were out of the market during a really good day. And so it also creates a lot of stress. If you get out of the market, well, when do you get back in? When do you get back in? So timing the market doesn't work. And diversification matters. Having a well-diversified portfolio so that as some sectors do well, some sectors don't do so well, and each year they're fluctuating. And as long as you own the market, it's well diversified, you don't have to worry about it. Like gold, someone asked about gold. Well, if you're heavily into gold, well, maybe gold is doing well right now, but oh, what about next year? Maybe it won't do as well. And so, having a well-diversified portfolio just takes some of the worry and stress out of investing. All righty.
So there are two ways that you can view your accounts if you are a client of ours, and one of them is the Dorsey Wealth Management Client Portal. The second is the Charles Schwab website. And both of these can be accessed through your Client Portal tab on our website. And if you have any issues, please let me know. I am your point person for all technical difficulties and connections. So I'm happy to answer anything or walk anyone through if they're having problems, which come up from time to time. So just let me know if I can help.
Great. Thanks, Amy. Yeah, if you have any connection issues, talk to Amy. All righty. Well, now, this is our last official slide here. We will be addressing some of the questions that have been coming in, and also some of the questions that came in as you registered for this webinar. But first of all, I just want to thank you so much for joining us. And as always, please reach out if you have any questions. So some of the other questions that we've gotten, over the last few days, is now a good time to invest? Is if you have some cash, or something has changed and you want to know, well, is now a good time to invest? I like to go back to the quote, the best time to invest was yesterday. The second best time is today. We can't time the market. We just don't know. If you invest today and maybe tomorrow we'll have a rally, wow, that was great timing. Or maybe tomorrow the market will go down, you know, hundreds of points. We don't know. I would say that a good time to invest is per your investment plan, as long as you know what that plan looks like. and that you are properly allocated. It goes back to the allocation. If you have short-term needs, make sure you have short-term needs in cash. Don't invest money that you will need, let's say within a year, because what if the market goes down and then you have to pull money out? You don't want to ever be in a position where you have to pull money from your investments and the market's down. If you have spending needs, spending goals coming up in the future, you should really plan ahead and have that cash on the side. So that answers that one. Amy,
We
you want
got
to take some of, oh,
Sure. We got a great question of what does net asset value measure? So net asset value is the metric that investors and fund managers use to understand the value of a fund's holdings. And that really just means that it's looking at the fund's assets and it's subtracting its liabilities. And it's per share. So that's basically what it's showing you when you're looking at a net asset value. I know there's so many acronyms in this industry. It's absolutely insane. So I hope that answers that.
yeah, hopefully that answers that. If you have any other follow-up questions, please feel free to put it in the Q&A.
Absolutely.
Let's see. Another question we got. What's a reasonable rate of return to expect? We get that a lot, and it really goes back to that one slide that showed the risk and the reward, and then the average that you would see per year.
Mhm.
And actually, let's go back to that. Yeah, let's go back to that slide because I just love this slide too. Um, what rate of return should I expect? Of course, we don't know for sure. It may be higher, maybe lower, but ballpark. I think this slide does a really good job of saying, well, it depends. It depends on your allocation. If you are more aggressive, you have an opportunity, you have a chance of getting a higher rate of return, but you also have a chance, if we have a bad year, of having a really low return that year. But on average, the more aggressive you are, on average, the higher rate of return. And so going back to a typical 60-40 portfolio, around 7.23 has been the average return over the last, I think it was 24 years. Um, and so, that just gives you a ballpark figure. But then when we do our projections, we factor in a lower number just to be very conservative because we don't want you to run out of money. Um, but then we also don't want you to have too much money left in your estate. That goes back to the prior webinar. And so it's important to just know, tie it back to your goals and know, if you want to leave a legacy and you want to make sure that you can, fund your goals and feel peace of mind with your investments. So, yeah, thank you. Let's see, we have a little more time. Amy, you want to pick another question that we've received?
Sure. We got a question. It says, is there an advantage to 70% stock, 30% bond if I'm still in my 40s? I mean, that's a very specific question. The general answer would be if you're in your 40s, you have a long horizon. You have a long time before you are going to retire and you're going to be paying yourself your retirement paycheck, and you have a long time to invest still. So it really depends on, again, the size of your portfolio. It depends on what your risk tolerance is. Some would say that that's absolutely reasonable, and some would say that you could be more or less heavily or less invested into stock, depending on what your risk tolerance really is. And to figure out someone's risk tolerance, we actually do a quiz, and we do it periodically with all of our clients just to make sure that we're investing appropriately and that we're really reconsidering if anyone's risk tolerance has shifted over time because of the different life stages they're in. So uh, there is not a one fits all answer on that one. It is definitely personalized. It depends on your situation. That's the least favorite answer of most people.
Yeah, that's definitely, it depends. But yeah, the rule of thumb is the younger you are, the more risk you can sustain because you have more time for the stock market to recover if you do suffer a major downturn. So, yeah. Let's see. I have time for a few more. Here's one. Um, we, how often should I be checking my accounts? I would say as little as possible. Um, we go over your portfolio, during our review meetings, and if anything comes up that we need to discuss, there's any actions that we need to take, we'll reach out to you. Part of the reason why you're partnering with us is to free up your time and to give you peace of mind that someone is doing the worrying for you. So I would not look frequently unless you enjoy it and unless you don't get nervous seeing the downturns or too excited when the market goes up. You have
Yes.
to really manage your emotions on both ends. So, again, I wouldn't, I would highly discourage looking at, your investments. Someone said watching your investments every day is like having a yo-yo, walking up the stairs and then having a yo-yo where you're looking at the yo-yo and it's just too much. So let us do that for you.
Yes.
I think we have another one. It's time for one more with Amy. Well,
See.
let's see if do we have any that came in live? Yeah, no. Okay, why don't you hit another one that came in?
Sorry, I was looking at the questions over here.
Uh,
Do you mind throwing one my way, Angela?
oh, okay. Let's see. This one, we could do a whole webinar on this, but maybe we can. I'll challenge you, Amy, to answer this question in 1 minute. Um, should I do a Roth conversion?
Oh man, 1 minute? Okay, how old are you? How much time do we have? What is the size of your portfolio? It's like I'm just repeating myself over and over again.
Oh gosh.
Roth conversions are amazing. It is amazing to see the amount of growth that can happen where you don't have to pay taxes after that initial hit. So a Roth conversion is where you're taking money that's in a traditional IRA and you're converting over it to a Roth. So you have to pay the taxes on that money when you transfer it over, but then that money grows tax free. And when you withdraw it, you don't have to pay taxes on it. So it is, I love Roth IRAs. I mean, I call it the triple tax, the tax trifecta. That's my little saying for it. But I think they're fantastic. For most, I can't say most, often it is a good idea to consider. How's that for a
Yeah,
tactful answer?
that's a very safe, tactful answer. Yes. That is where really careful financial planning and tax planning comes in place because not everyone should do a Roth conversion. There are many benefits, but if you don't do it correctly, you'll just end up with a really large, ugly tax bill and you'll be very upset.
Mhm.
So,
It's true. There's so many different areas that we have to consider when we're looking at how much you should do per year, if it's an appropriate time to do it. I mean, we have some really fabulous software that is showing some graphs that actually most people can read now, which I love. Up until now, it's been really complicated to explain, I think. So it's fun. So if you have that question, please, we're going to talk about it in our fall meetings this year. So we are going to have some really colorful rainbow charts to show you about appropriate timing and such. But if you're not a client, that's definitely something to discuss, though. It is a huge consideration, and that is one of the areas where a financial advisor can really get into the weeds for you and make sure that it's the appropriate time and amount that you should be doing, if at all. So,
absolutely. Okay, we're just about out of time. Let's see if we have any other questions. No, we don't. So how about we wrap it up here? And again, thank you so much for registering and for joining us for this webinar. We really appreciate, the interaction and your questions.
yes, we had some
And
great questions today. Thanks
yeah,
so
yeah.
much for them.
A lot of questions for this one. A lot of
Yes.
questions, so that makes it even better. So again, thank you so much, and you will receive a replay. And if you have any other questions, feel free to reach out. So have a
Okay.
great day, everyone.
Thank you, guys.
Okay, bye-bye.
Bye.